I think I'm going to get a lot of grief for this video because this goes against what everybody has been taught. Everybody thinks you should buy in the right area. I think one of the first things I learned about the property market, it was my dad who said location, location, location. It's all about the location. Get the location right. Buy in Sandton, buy in Bryanston, buy in Umhlanga, buy in Greenpoint, buy in the nice areas because that's where you're going to make your money. I'm sorry to tell you guys, but this video is not going to be showing you how to do that. In fact, I think you should avoid suburbs. And in this video, I'm going to tell you exactly why.
I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low income multi-let residential market.
So I like to classify areas in two types of ways. You've got your low income and your high income, your town, your CBD, your high density properties, and then your low density, more affluent, luxurious properties. Now, the reason why I don't like the BURBS is because it doesn't fit into my strategy. Here I've got two areas to do a quick comparison on. The top one is your Kempton Park. The bottom one is your Fourways. Now, I have chosen that Kempton Park is more your lower income area, although there's quite a lot of affluent areas within Kempton Park, and then Fourways being the affluent area. Now, the key stats that you're looking at here are your gross yield and your capital growth. For Kempton Park, your gross yield is 13.6%. For Fourways, it is 11.07%. So what your gross yield is essentially telling you is whether an area will have positive cash flow deals or not. So Kempton Park's got a higher chance of being positive cash flow. That aligns with my strategy. Lacquer. The Fourways area, though, has better capital growth. You can see based on the stats here that the capital growth is estimated to be 6.7 versus your Kempton Park of 1.9. Now remember, you've got two ways to make money in property, and the BURBS just doesn't fit with my strategy. Now the two ways are cash flow or appreciation. Your cash flow market is where your rental income is greater than your monthly expenses, leaving you with a positive cash flow. Your appreciation model tends to have the reverse. You tend to have lower income for your expense, meaning you have to fund the shortfall. Now, the reason why you would still go appreciation is because your cash flow market doesn't tend to appreciate as much, right? It's your cash flow strategy. You're making your money on a month-to-month basis, but your appreciation is not great. Versus your negative cash flow route, but your appreciation tends to be higher. So this is why most people are quite comfortable investing in like the Fourways, Bryanston. Even though there's a shortfall, they're like, you know what, I'm making my money in the long run. Now, the reason why I'm probably going to stop you from ever investing in the BURBS again is because I think that perception's wrong. Yes, there is this idea or opinion that you've got a higher chance of appreciating in the suburbs or in the nice areas. But actually the statistics show that there is a better capital growth in your low income market. So this is a deal where I got convinced that I was buying in the right area and I was going to make profit. It's a property in Fourways. Now, Fourways I like to think of as an affluent area. I held this property for 7 years. It was not in bad condition when I bought it, but I did renovate it slightly. I put in new tiles, new kitchen. I made it really clean and quite attractive. And my expectation was that this thing was going to grow at 6.7 or maybe even 10%. That's what TPN stated, and that's what I thought was going to happen. In reality, I had minimal growth. In reality, this thing that I bought for 800,000 in 2014, I only sold for 950 in 2022. So over 8 years, 7-8 years, I made a capital growth of 2.3% per year. Now, the reason I thought that it was going to appreciate massively is because of that photo there in the big property. That's the mega mall in Fourways. I thought, as did everybody that I spoke to, Fourways was going to appreciate massively in value because of this new development, this massive commercial building. But the reality is that I spent 8 years getting a 2.3% growth. Misperception and speculation, man, that's the dangerous thing. We have this perception that the suburbs is just going to always outperform and grow, and that the low income market is going to shrink, and that your value of your property is much better sitting in the suburbs. But I'm here to tell you that that's just not the case. Now, the reason is because of supply and demand. The reason my property in Fourways, even though the data from TPN suggests 6.7%, the reason that my property did not escalate at that rate is because of developers, because of supply and demand. Now in Four Ways, when I bought in Four Ways, there were a couple of buildings and there were a lot of tenants. But there was a good match, right? There was enough buildings to meet the tenant demand. Then this mega mall started to come in and there was a big drive and people were starting to come to Four Ways. And then you know what happened? All these developers, the Baldwin guys, your Growth Point, they all came in and they're like, okay, there's some growth in Four Ways. So what we're going to do is we're going to put a whole bunch of developments in place. And that's what I started noticing after I bought my property, I saw all these developments coming up and I thought to myself, yes, oh man, my property is going to go up in value. That's what I thought. I was like, okay, cool. I'm going to make so much money. But the problem is there wasn't that many tenants coming in. So there was all the supply, so much new building, so much more supply was coming in. And these developers were building at a cheap rate. So they started selling their properties, their 2 bedrooms for $700, $750. Now, why is someone going to come and buy my property for 1 million or above 1 million when there are 13 new builds in and around my area that are going for 700? So all of these developers were bringing so much stock, so much supply that it was driving the price down. So yes, the suburbs, the affluent areas have a better chance of appreciating, but they're also attractive for developers to come and put thousands of new builds and developments in the area. And all that's going to do is going to drive your price down, because now you've got the same number of potential buyers or investors or homeowners. And now instead of coming to my unit, which is 20 years old, they're just going to go and have their pick of the stock that's available. So yes, affluent areas work, but there's also more property supply in these affluent areas. If you've got one tenant who has a choice between 3 houses, he is in the power position. The buyer is in the power position. And now you've got a buyer's market. And when you have strong supply and weak demand, you drive the price down. And there's no better case study than the wealthiest square mile in Africa. Good old Sandton. Now, I don't have a property in Sandton, but a couple of my students do, or at least the students before they joined my program, they had properties in these areas. I would not recommend that. I wouldn't teach that in my program. And what they've told me, or a specific student of mine, told me that in 2010, they used to rent their 1-bed apartment for 10 grand. For 10 grand. They're now renting it for 7,500. Why? Well, because there's just so many options. Yes, there's tons of people coming to Sandton, and yes, probably over the next 5, 10, 15 years, there'll be some good appreciation. But don't get it twisted. There's developers, there's institutional money that also sees these options and is also taking advantage of the increase in demand. So figuring out the increase of demand and supply is important, because if you've got a massive amount of supply, if you've got 1,000 developers coming in and pumping as much property as they can into an area, you best believe that the property prices in that area are likely going to go down, because increased supply and weak demand drives prices down. I hope that I haven't completely turned you off the burbs, but I do hope that I've opened your eyes to say that that's not the only place to make money, and that the guarantee and our perception of what's a safer choice, I don't think that's come into question. When I go to O'Brien, I tell people that I invest in property, and I tell them that I invest in, likes of Hillbrow and CBD and Rosettenville and whatnot. I mean, they look at me and they're like, bro, are you not crazy? The risk. I mean, why are you risking your money there? And, it's such an interesting question for me, because I don't think the risk is there. I think the risk is in the burbs. Let me give you an example. Let me give you a scenario. Would you rather buy a 2-bedroom apartment in Four Ways, where you're probably going to pay R1 million and you're going to get 7,500 Rand rent? Now, within this Four Ways property, you're probably going to have a tenant all the time, and that tenant's always going to pay. You're not going to have any problems there. But it doesn't matter how good your tenant pays, you're never going to be cash flow positive, at least not for the first 5 to 7 years. So you're going to be funding this guy's lifestyle for a while before you break even. Versus buying a 2-bedroom property in Hillbrow, where you're also making 7,000 Rand rent, by the way. So you make the same pretty much that you're making in Four Ways, but you're buying it for 250, 300,000. Now, yes, you're going to have some delinquent tenants, and you're maybe going to have a tough tenant, or you're going to have to do an eviction or whatever it is. Like, that does happen. But let's say 10 to 11 months of the year, you're in a positive cash flow position, and 1 month you're making a loss. Which one's the safer option? A business that's profitable from day one and has an infinite amount of demand. There's an infinite amount of people in the CBD of Johannesburg that need accommodation, and there's not that many developers pumping up new buildings. Versus four-ways, where the demand is pretty good, but the supply is even better, which means that the appreciation that you're promised, that you think is coming, is probably going to be swamped out by the stock that is now available for 700,000 or 800,000 Rand. So in summary, I hope that you see now that the BURBS is probably not the best place to invest. I'm not saying you shouldn't. My portfolio, if I had to think about it now, I probably have about 80% exposure into the low income market and 20% exposure into the suburbs. And my 20% is mostly new builds because I want that Section 13(6) Act benefits. But I do have a couple of properties that I'm hoping will appreciate in time in the likes of four-ways and Midrand and that kind of stuff. But bulk of my investments are in the low income market because my strategy is cash flow. So you got to figure out, what are you trying to achieve? I hope that you're not too negative about the BURBS, but I also hope that you're a bit more educated and that you don't just follow the perception of the many, but rather make an informed decision that helps you get to your financial goals.
I hope you enjoyed that video. Give it a thumbs up if you did. Please go and check out my YouTube membership. You get access to exclusive content. I'll also analyze live deals on your behalf. So go check out my YouTube membership for that and so much more.